We had a huge percent drop from the peak there at 82 to the low just below 70 in a matter of 48 hours. Then all of a sudden, where are you right now? You're trading at a price level that two prior peak closes closed at, just above 77. Silver still in the range of 1975 to 80 through 2011, only just now has broken out in silver freshly, and it's only done it by a month or so. Don't be shocked if silver does a copper or a lead, or what gold has done repeatedly over the last 50 years, which is to say, blow out the old high by leagues. And gold, for example, the two bull market runs that we have in the last 50 years were both eightfold moves, bear low to bull high, bear low to bull high. Our bull market started from a low in 2015 at $1,050, in which case you go eightfold, you're going to be $8,500 just to match the ratio scale of those two prior bull markets. In which case, if silver's 2% of 8,500, again, gold just doing what it's done twice before, an eightfold move, and I don't expect that'll stop it, by the way.
Silver has seen extreme volatility, plunging from a peak near 82 to below 70 in just 48 hours before rebounding to the 77 level, a zone matching two prior peak closes. According to market analyst Michael Oliver, this does not invalidate the broader bullish thesis. Silver has only recently broken out of its long-term 1975-2011 trading range. Oliver notes that metals often overshoot old highs dramatically, as gold has done repeatedly over the past 50 years. With gold historically delivering eightfold bull runs, silver could be setting up for a powerful long-term upside move. Now, we present the clips from Michael's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
Gold and silver, because they're degrading the money units underlying their markets. And that's further panic fuel for gold. Now, the question then is, what about the top in silver? Yeah, there will be a point at which, let's say after the next 6 months, silver will go to a new reality and possibly even overshoot what you could consider to be the new reality. So if it's going to live in a range that's a couple $100, maybe it goes to 500 first. Okay, why do I come up with that number? If you take the last 50 years in silver, it was a tenfold range from bear lows to bull highs repeatedly. $4 or $5 lows, $50 highs. Tenfold. Take the dimension of that on a ratio scale and add it to the top of $50. 50 times 10 is what? Okay? You get the point. It's a simple swing measurement of the ratio scale of that range. It would not shock me that if silver goes to a new reality of several $100, that in getting there, it goes past the new reality in an emotional burst. Markets do that, overcompensates, and then settles back into the new reality. And also at that point, I don't know where we're going to be in terms of the major fundamental crisis that I just mentioned. The government debt bond crisis, the dollar dropping versus other currencies, which it's in the process of doing, the plight that might be suffered by commercial real estate, heavy in debt, long-term debt, not behaving well technically. All these events out there could create a new reality in terms of our fundamental assumptions about where we're going to be in a year or two. We go into a new reality where maybe silver and gold become monetized here, there, suddenly spreading across the world. So their new reality they stay in, okay? Get the point. This is not a normal bull market. Gold isn't even at its normal eightfold move. Heck, it's done it twice in 50 years under conditions that are far less horrendous in terms of fundamentals. And it's only fourfold? We're only halfway to where we were in those two bulls. So if gold goes to 8,000, where would silver be if it's just 2%? Get the point. Okay. Yeah. So hold tight.
$100.
Yeah, easily. And I think that's where we are right now. And so when I hear this constant chorus of that's the top, it's got to correct, got to go back to 50 or 35 or whatever they want, it just doesn't happen. And now the breaks, instead of being spanning a couple weeks or 3 or 4 weeks, like remember October, it wasted about 4 weeks there. This time it was 2 days. Okay, you get the point. We're arguing that don't be shocked if the price took out the range highs of the last 50 years. Why won't the spread maybe also challenge the highs of the last 50 years, one of which is over 3% and one over 6%? So everything we see regarding the monetary metals, and especially silver component of that, is freshly broken out and still cheap.
Okay.
So don't be shocked by a thunderbolt. Well, even what you just see there recently has been a thunderbolt, but a lot more to come. And again, that's not the way you top something to freshly break out of a decade-wide base.
You just
broke out. That's not the way you top.
Basically right there, right?
Yeah.
Like that box right there, the last 10 years, and we've now just gone above it.
And, 2%, by the way, if you go back 50 years, is commonplace. The number of the years that were at least 2% or higher, that lower line there, was 20 out of 50 years. So I would say fully expect at least silver to reach 2% the price of gold, and probably challenge or take out maybe one or both of those old highs, and do it quickly. Because if you look at those highs at 6.5 and 3+%, that surge was very rapid. And that's also when silver went ape on the upside during the latter phases of those bull trends, mid 79 to the 80 peak, or the September 2010 through April 2011 peak. In net price, silver exploded geometrically. Silver versus gold, where has it been before? Hey, maybe we go there again. Why not? Price just took out 50-year high. Where might gold go under a normal bull market? Eightfold. Oh, okay. Is that a big deal? No, you've done it twice before. Times are different now. Maybe it goes further. Silver ratio to gold. Breakout versus the stock market. All of these are big macro technical events with underlying fundamentals, and they've just begun.
Silver and gold are rising not just as commodities, but as monetary assets reacting to currency degradation and mounting global debt risks. According to market analyst Michael Oliver, silver has decisively broken out of a 50-year range. And this is not how bull markets end, it's how they begin. Historically, silver has moved in tenfold cycles from bear lows to bull highs, suggesting prices could overshoot a new reality before stabilizing, possibly into the hundreds. With gold only halfway through its historical eightfold bull pattern, silver at just 2% of gold remains cheap. Expect volatility, but don't underestimate the breakout. This is a macro shift, not a top. Let's get back to the interview.
Silver spreads versus gold, and let's say where might silver be if gold's at 8,000 and silver goes to 3%, like it was in 2011.
$600.
You're talking hundreds of dollars an ounce, and all of these metrics help tell us strongly silver is in a tantrum mode to catch up to a new reality that it's avoided for so many decades, whereas other markets have not. Yeah. This is not a normal move. Okay, what about the top? There are bigger factors going on here than just another bull market in silver. We have an asset class shift that just began out of the strong U.S. stock market, stronger than most in the world. It's a bubble. The monetary metals are broken out freshly. You can expect that breakout of an 11-year wide base not just to go up for a couple months. It's going to go up and stay up for a couple years, if not more. I think the events that are about to unfold technically in certain asset categories like U.S. government bond market, Japanese bond market, UK bond market. We have a government debt crisis, and it hasn't really unleashed yet, and I expect it will at some point, probably in the next few months, where you get further downside in those markets. I'm talking long dated, like 30-year bonds.
Okay.
And a spike up in yields on the long end, despite what the Fed does on the short end. That will cause a major bubble piercing crisis in the stock market. Right now, the stock market has ignored the sustainable high yields that have occurred in the bond market because they're quiet. They're not going up, but they're not going down. And it's when that sleepy market, the T-bond market, which right now is trading like at 115 on the bond futures. You go back to October of 2022 when it collapsed, and it was at 117. So after 3 years of effort to rally the bonds, drop the yields, it hasn't been able to do so. Something's wrong with it. It can't get going on the upside or drop in yields. That's a crisis event pending out there, the kind that could pierce the stock market. And when you do that, that's when panic sets in among central banks, especially when their government bonds are in jeopardy. And the head of the New York Fed, Williams, a month or so ago, said that the Fed is going to, quote, start buying bonds.
Oh.
His explanation for that was not, oh, that market's in trouble, U.S. government bond market, but it needs liquidity, a polite way of giving an excuse for the Fed to be buying bonds. They've been buying for 2 months and that market has not rallied. So I think it's a pending crisis of huge dimensions.
Silver is entering a powerful catch-up phase after decades of underperformance, according to market analysis tied to gold's trajectory. If gold reaches 8,000 and silver merely returns to historical norms of 3% of gold, prices near $600 per ounce become plausible. This is not a normal bull market. Monetary metals have broken out of an 11-year base while U.S. stocks sit in bubble territory. A looming government bond crisis across U.S., Japanese, and U.K. markets threatens to destabilize equities and force central bank intervention. As bonds fail to stabilize despite Fed buying, silver's breakout looks durable, signaling a multi-year move driven by macro stress and monetary realignment. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.